Good morning and welcome to another GemCap Academy. It is my pleasure and delight to welcome an old friend, an old colleague, Tony Meadows. Good morning to you, sir. How are you?
Morning, Stuart. How you doing?
I'm very well indeed. I love the fact that you've got a white shirt, white background, and white hair going on there. It's a nice blend.
Where does the hair end and the wall begin?
Exactly. Now, Tony, we've known each other a very long time. We worked together at Close Brothers, where you were the CIO, one of the CIOs. Is it 20 years you've been a CIO, 30 years or something in the industry?
Yeah, we're coming up to 34 years in the industry and 20 years as a CIO or equivalent. About 25 years in advisor-led businesses. So a long time.
Well, you're someone that I've always enjoyed your company because you've always got some great views on the industry. And we recently spent quite a lot of time together, didn't we? We had a little bit of a road trip.
Yeah, we did.
So for those who don't know, Tony joined me recently on one of my little expeditions to Ukraine for a charity called Mission Ukraine. And Tony was a co-driver in a Skoda Fabia Comfort. The word comfort, by the way, is a misnomer. It was not comfortable at all. However, Tony and I and a bunch of other guys drove across to Dnipro, delivering humanitarian aid and cars for the military and for local charities. So thank you for that, Tony.
Cars that have been around nearly as long as us. 21-year-old car.
Yeah, 25 years or longer in some cases. But yeah, it was a great effort. And we spent a lot of time on that trip talking about some of the industry issues. And the industry is in a state of flux. There's no doubt about it. We're old enough and long enough in the tooth to know that these changes, they're not sudden. They've been coming for quite some time. Where do you see where do you see these changes in particular at the moment, Tony? What do you think is happening?
I mean, there's plenty of things that we could talk about. One of the big things I think is probably the value chain. How clients charge, what are they charged for, and who's within that mix. We've obviously had the rise of passive, for example.
Yes, yeah.
Various reasons you can talk about from various different angles, but
do you see the rise of passive? Is passive? There's a lot of people who are very pro passive at the moment, no doubt about it. And then, I was actually part of Morgan Grenfell back in 1988 when we launched the very first index tracker fund, a passive fund. And I remember a certain individual, Peter Hargreaves, telling me, "You'll never sell a bloody thing like that in my house." Sure enough, they do buy passives now. But is it about price, or is it about performance, or is it a combination of the two? Because this rush to the bottom that we're seeing on price on everything just makes being a fund manager quite a challenge. Where do you see the pricing issue going?
There are various aspects to that. I suppose you've got to start off with us sort of putting portfolios of funds or a mix of funds and direct things together. What are we trying to do? Well, we're trying to spread our risk. We're trying to tilt portfolios to the right sort of factors. So everything has a role within the portfolio. Now, I always say that we decide to do something and change something because we've got a good idea, and then it's about the reliability of that delivery. And you should pay up for a reliable expression of what you're trying to do. So that's probably an active manager. But if you can't find that reliably, then you should pay as little as you can for that. It could be passive. It could be you're the cheapest resource because you've already been, I suppose, paid for in that chain, and invest directly. And at various stages in my career, firms started off doing things a lot more in-house. Then they moved to the cult of the I suppose the active fund and fund manager, and then we've had the rise passive. And to a certain extent, passive, it becomes self-fulfilling, isn't it? Because you're buying the largest elements of the index, and if that's working, and we're dominated by the US now and technology, then you're sort of perpetuating that by buying a passive and keeping that momentum going.
Right. But
is that the right thing to do?
Exactly. exactly. But the rise of the MPS has created this artificial move to passive you were saying earlier on.
I think
Where's
it
that
has, but
going to
then
end?
that's coming down to, the value chain and what you pay for. Now, a lot of, so on average, a model portfolio service will probably be about 40% passive now.
Wow. Okay.
Now, is that for the right reason? Is that because they can't find reliable delivery of, I suppose, an active expression of what they're trying to do? Or is that to create space for their own fee structure? Because they're obviously taking a charge to run the portfolios. I think a lot of it actually is to reduce the overall cost of delivery so that they can charge. And even with MPS, you've got a race to the bottom. It's the wildly different sort of fee rates applied.
What are the fee rates out of interest?
Well, it used to be you would probably talk about running discretionary money for 50 basis points. Well, that's long gone. Now you can get a managed portfolio service for 6 to 8 basis points.
How does
And
anybody make money?
well, the overall, I suppose the overall cost of delivery then in that is that most MPS, as far as I'm aware, coming in around about 70 to 75 basis points. So that's sort of the underlying managers, and 60% of that is probably active, 40% passive. You're probably paying 10 bips for the passive and whatever you're paying for the active manager. And then around about sort of, if you take the bottom end, 8 to 15, 20 basis points for the actual overlay. And you've had the rise of different services as well. So you can use different building blocks. I've run purely passive portfolios or a mix of active and passive. Now, the charge that you're getting is for active overlay over the building blocks as well. So you are getting something for it, even if you're using passives.
But we touched on this value chain a few times now, but I struggle with the whole chain generally because there are so many snouts in the trough who are feeding along the line. I mean, particularly, I see it from the fund management point of view, where the creation of a fund and the maintenance of a fund. There's so many different levels that you need to bring in and layers that you bring in to maintain the regulated environment and the correct regulated environment for that fund to function. And the number of times I mean, the invoices we send off to various companies for their services to do this. Is it the same at the other end for the wealth managers who are creating these MPSs? Because I know the platforms obviously have their costs. So who else is feeding in that area?
Well, so look at it from the client point of view, really. In the private client world, it used to be that you were trying to aim for a value chain that's around about 200 basis points. And that's taking account of the advisor, the DFM, so discretionary fund manager, the underlying building blocks, the fund managers or the passive elements, and then the platform. And that's been cut in different ways through time. Probably you're not talking about 200 basis points now, you're talking about 150 or 100, and it's kind of coming down to value for money. Yeah. So there's a lot of heads in that, as you say, in that trough. Still, I suppose the lion's share of that money accrues to the person with the relationship, the trusted relationship with the advisor. We can sort of talk about whether that's right or wrong. The areas that have been under pressure have been obviously the active delivery, and also the DFM charge. Yeah. I think an area that hasn't really sort of been squeezed yet, but is going to be platform, because I think ultimately platform functionality is quite poor.
Yeah,
and there's not really a differentiation across the platforms. They all seem to have the same problems.
Yeah. Let's just touch on active management, which is obviously an area that we at GemCap focus on, and with our active managers, and we're proud of the managers that we have on our platform, and we support them as best we can. But they're under massive pressure. The point that we discussed before we started recording was, there are just too many active managers out there, and there isn't a day goes by that we're not approached by a new manager. And the boutique managers that we generally attract, they're still out there and they're still being created. You don't, it's not a case of two be created and one's disappearing, although there are managers who are closing, particularly in sort of hedge space, the long short area. But on the whole, the growth of the active managers continues at a pace. Do you see that continuing, or do you see pricing pressure causing the demise of active managers?
Well, I think active is a smaller pool now, isn't it? Because of the allocation to passive.
So they're all fighting for a smaller.
They're fighting for a smaller pot. So then, how do you differentiate yourself? Well, you do that on the basis of reliability and performance.
Yeah.
Or you do it on fees. Now, we've all seen the stats around sort of the average active manager not sort of beating benchmark.
Yeah.
And that's true. So that probably shows that there are options out there in the active space.
Yeah.
And I always say, as a retort to that, is that we're not trying to pick the average manager. There are still enough good managers that reliably deliver.
Yeah.
And why shouldn't you pay more for that? But the problem is are they all having to discount just to get that smaller flow?
Yeah, I think unfortunately they're under huge pressures because some of the big houses are offering, if they're launching a new fund, a big house will offer a new fund at 25 bips OCF. Well, boutique can't compete on that. Not in the early days, because they'd have to subsidize the fund. A fund launch would normally have around about, if it's sub 25 million, would probably have fees around about 30 to 35 bips at 25 million. Once it's above 50, then the fees drop to sort of 15, 16 bips. So if you did, that's exclude the investment management fee. Add the investment management fee and any other fees, you would struggle to get a fund away for less than 50 bips. So as a boutique active manager, whereas you're competing against the big boys who go, well, we can subsidize it because we've got X billions and trillions over here. So it is a challenge. When you're looking at fund selection, when you're looking at the funds and the firms you work with today and previously, what are you looking for? Do you start off on the fees? I mean, surely that's the last thing.
Yeah, exactly. I mean, it's all about that reliable delivery process, resources, the history of doing something that they said they do, or behaving in a way that I expect that fund or those investments to do, so I can reliably use it within a portfolio where I'm spreading risk across a number of investments. First and foremost, that's what I want to do. You want to do the best. You want to put your money with the best expression of that.
Yeah.
And let's not forget, if it's reliable delivery and it costs a bit more, well, you're probably spending a bit more of what you wouldn't have got if you go to someone who's not very good at it.
Yeah.
If that makes sense.
Yeah.
But the focus is completely on cost. Now, I've worked at firms, and you look at different asset classes, and you have to pay. There's a different expectation around what you're trying to achieve there in terms of that reliability and the cost of delivery. So, for example, alternatives. A lot of alternative funds, you're probably budgeting within your portfolio around about 100 basis points for alternative exposure. Now, because of that, it's got a great role to play in diversifying your risks in the portfolio. And if you can get it reliably, great. But some houses won't allocate to alternatives because it's taking up too much of the budget. Or if they're doing that, then they're going passive on the equity front. So could you be missing out on something that you could get reliably on the equity front by just having a cost consideration?
Right. Oh, you've probably followed with interest like I have certainly the last 2 years. Everyone's been talking about private markets, private equity, private credit, whatever it may be. I've got an issue with those, particularly in that what I call the wholesale space, because I think it's quite challenging. And yet, some of the big asset managers that say, yeah, we're pushing private markets to the whole market. Do you see that as someone who's a fund selector? Do you see private markets as being a dominant part of your future allocation?
I suppose it's interesting, and we can talk forever on this, and sort of de-equitization, fully, our public markets fully functioning. The US is dominant, has an active IPO framework that some of the other markets don't have. When I joined the city, there are over 1,000 companies in the all share. Now we're sub 700. It's not just a UK issue; that's the developed world. And because of, I suppose, access to capital, you've been able to roll up on the outside and haven't needed to come to the public market. So there's been very lucrative returns in the private space. Now, one of the inconvenient things, particularly in private clients, is we've given clients a short expectation window to judge us on.
Right.
And I think that comes back to the old structure of how we used to sell. We go back to sort of sales teams that were incentivized on a 3-year window.
Yeah.
Well, the time horizon to judge us was obviously going to be 3 years. When in reality, some of the instruments you're investing in equities become reliable at about 15 years.
Mm-hmm.
And clients' time horizons are normally a lot longer than we're telling them to judge us over. So we've naturally sat in the public space selling the mantra of liquidity. But if you've got a very long time horizon with longevity and generational wealth, you could be looking at 25 years, 30 years plus. Why couldn't you tie up some of your money into the private space? I suppose it comes down to how sensibly you do that, because you don't want to get caught in a liquidity trap.
Yeah.
I do think the returns that have been available in the private space are higher than they'll average out at.
Right.
And I think we're in a completely different environment in funding terms.
Mm-hmm.
But I think that we perhaps need to look at a different way to explain the narrative of a portfolio. And as a result, could we choose a good investment that rolls up on the outside in the private space as opposed to public? Because the avenue's not there anymore. They're not coming to the market. But do we miss out because they're not coming to the market? So I think we need to include private, but we need to be sensible about what we say to clients, the expectation, and how we set those liquidity processes.
And that's a really important point, because in the world that I've growing up in distribution, we would say to someone like yourself, to a fund selector, fund buyer, we say, obviously you need to look at this on a 3 to 5 year view. And they go, of course we do. That's what we do. That's what we impart to our clients. And we go, great, fantastic. 3 months after they've bought the fund, they're challenging about the performance. Their time horizon has just suddenly shrunk. And
part of that is because their clients challenging them because they didn't lead the expectation of the client.
Well, exactly. So, and yet there's some great investors. If you had taken a 3-month view on, I don't know, Charlie Munger or Anthony Bolton or Peter Lynch or people like that, you'd have been in and out like a drunk in a pub. You just would not. But buy funds, you would literally just say, can't be too volatile. The reality is, if you look at the long-term investments of any fund, reasonable fund, it's pretty well straight line. It's we all talk about you and I were actually, were you around the 87 crash? I don't know if you were. Were you? How old you were.
I missed that one, but someone told me about it.
Yeah, I probably told you about it in the car. But the 87 crash, it's literally, you don't notice it on the line anymore. It's so small.
Right.
It's what trust me, at the time, it was terrifying. Particularly in those days, because every fund manager was working with at the pub whilst it was going on. Nothing they could do. But I do feel the timelines there's a disconnect between what fund managers are producing and what fund selectors and fund buyers are expecting.
Yeah.
I wonder whether or not that will ever change.
But also as well, I mean, that also comes down to, I suppose, luck and skill, because what I'm looking for is that repeatable process and that exposure that gives me a return stream that I can understand and then use within a portfolio. That can also give me, or I can structure a portfolio to give that individual manager more time. I'll know when they'll be doing well or should be doing well, and when their particular style doesn't work. Now, the other side of the coin is you wind back to that period where we started in the city, and it was about, I suppose, the cult of individual fund managers. And at times, when you look at sort of factor exposure and growth in the ascendancy, sometimes is it about the skill of the manager or just the exposure that they're giving you? And there's plenty of people that made a lot of money out of probably being more lucky than good. But we should, if you can get sort of, I suppose, true alpha, and true alpha sort of can be transitory, then you pay up for it. But I think at the moment, because we've got, I suppose, there are too many options, and the available pot is dwindling due to the access to passive, that I suppose good managers are undercharging, and poor managers are earning too much.
Yeah, I mean, I was talking about this with someone the other day. I mean, when I first came into the industry, I was working for Gartmore back in the tail end of '86. I had 6 competitors. I'd go out there talking to stockbrokers, insurance brokers. The intermediary IFA didn't really exist then, just started to come in as commissions changed. And so you had 6 competitors. Today, there's 600. If not 6,000 managers you're competing against, particularly in London, where it's an oversupplied market. As someone who deals with fund managers day in, day out, I'm going to put you on the spot now, Tony. I apologise for this, but what do you think are the key factors that a fund manager needs to play to get your interest? What are the key? I mean, let's give 3 aspects that they should play to get your attention as to why you should be buying those funds.
I think first and foremost, it's a clear methodology. So what are they trying to do? How do they invest? So that gives us I suppose a heads up as to how the fund should perform and when it should do well or not. Then there's the process to convert that sort of methodology and philosophy into practice. How repeatable it is, and what resources are available to them to give me comfort that they can keep doing this through different cycles.
Okay.
And that then you're going to get into, once you've gone beyond the team, you then get into the structure of the firm, how are they incentivized, etc.
Now,
but it's repeatability, basically.
Well, as a fund sales guy, see, I'm disappointed with that.
Why? What would you want it to be?
Well, it's because how do I get the fund? And this is a question that every fund manager should be asking. And there are some great people out there who can talk the hind leg off a donkey about this. But how does a fund manager get in front of you? How do they find? How do they find out? By the way, this is not a big pitching a fund manager to you, but how does a fund manager get in front of Tony Meadows today when there are so many fund managers out there? How do they get the email into you? How do they get the phone call into you? How do they get the meeting? Talk me briefly through that process.
A lot of it will be depending on where we're looking.
Right.
We will have a particular role or problem within the portfolio that we want to solve. We'll then look at the available universe. We'll do quantitative screens, and then that will lead to a medium list, and basically we'll send the RFPs, usual process, and we'll get down to a short list. Outside of that, we're generally looking at asset classes and for views and to follow and to find out who might be a good manager. But we won't always be looking in that particular area. So it's harder. If we're not engaged in an actual search, it's harder for you to get someone in front of me, because I'm consumed by what we're trying to do or achieve, and it's quite a time-consuming process. Now, apart from that, if you're coming to me and pitching a manager to me, it would be show me how reliable they are at delivering either regional or a factor exposure. And we will benchmark. We won't benchmark them against the wider index. We'll benchmark them against their style, because sometimes their style does the job for them, as opposed to their skill, and we want to differentiate the two.
Yeah.
So if I'm not engaged in a search in that particular area, it's going to be hard to get someone in front of me unless you can show me that is a manager that I suppose has longevity at delivering a particular style of investment portfolio.
Okay.
On a basis that's been successful. And success isn't always basically about being the top of the table, because the top of the table can be
absolutely
short term and based on other factors. We used to sell against funds by saying to buy the top performing fund over the last 5 years, and then we'd show them the chart for the next 5 years, because obviously we take a historic chart, and none of those funds would be anywhere near.
Yeah.
I'm not buying past performance. I'm buying, I suppose, future reliability to deliver something within a portfolio that I can understand. And I've been at various houses when we were building out ranges without saying any names, and growth was in the ascendancy, and I was putting some value in the range. And a senior person came to me and said, "Why are we launching funds that are underperforming?" To me, they weren't underperforming; they were performing in line with their style, and they stood ready for me to use within the portfolio when times change.
Yeah, exactly. It's like, well, the old value growth, value or underperformer growth is outperforming, and so on and so forth. But
so okay, we might look at things on that basis. Like we're trying to find the best manager in each area to do a certain job, but it's going to be hard if I'm not doing a search.
Okay, let's wrap things up here today, and I'm going to ask you to get your crystal ball out. Where do you see the industry and the relationship between fund managers and fund selectors? Where do you see that in 5 years' time?
It's interesting. I think there'll be less active managers. Mm-hmm. We're already seeing that. I think that's probably there's some good elements to that. We're trying to focus in on I suppose the best and the most reliable. I think there'll be more cheap delivery, mm-hmm. and it won't just be. So this might be a move away from passive on the basis of market cap weighted indices, and more reliable style or factor delivery, but cheaply. A lot of thematic as well at the moment in the ETF world is too expensive. 40 basis points for thematic investment. I need that to be down at 20 basis points, really. So the race to the bottom is going to continue to a certain degree, but it has to be. But I think, I suppose, can I race to the bottom on some parts of my portfolio so I can pay more to reliable active managers on the other side? So I think there's more thematic needs to come into the I suppose the universe. Rules-based cheap delivery, swaps, dare I say it as well. Mm-hmm. You can get a tradable basket for 4 basis points in equities, mm-hmm. and that's active. It sort of makes active look expensive. And I think there might also be full circle move on the wealth side to there's some talented people being let go by retail fund houses. What if one intended consequence is we employ them on our side to do direct here than those investment houses?
So basically, going back full circle to what it was back in the 80s.
Yeah, could we undercut you because basically we're not paying extra for it? We're just employing the resource to do it. Now that's probably the larger houses rather than the smaller houses, because as you said about boutiques, there's a high fixed cost to running one. And you need scale in order to do that. But if it's about overall delivery, then why wouldn't we do that?
Okay, Tony, thanks so much for your time today. Appreciate I've taken you away from a busy schedule. Um, I look forward to catching up with you maybe on my next trip to Ukraine, as and when. But in the meantime, I'd like to see you as always. Enjoy the rest of your day, and we look forward to speaking to you soon. All the very best.
Thanks very much, Nick.